Hello and welcome to this IBSA podcast on the topic of US exposed persons moving to Europe. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. And today I'm joined by Derren Hayden-Joseph, a US lawyer specializing in international cross-border taxation for US individuals. Maybe they're moving to the UK or beneficial regimes such as Spain or Italy, or other fairly high tax jurisdictions such as France and Germany. Darren will also be covering the taxation of trusts in the US and beyond. So there you are. Darren, what are your key points that you'd like to talk about?
Hi, Roy. Pleasure to be here again. My name is Derren Joseph. HEJ.tax, a member of Moore's Rule, and we're a team that seeks to demystify the sometimes confusing world of international tax. One point of correction, I'm not a lawyer, I'm a tax advisor. So just don't want to get in trouble. Now, in terms of what we want to cover, yeah, we can definitely talk about US exposed persons, whether they be citizens or green card holders, and the world of options in front of them, primarily Europe, but we can also talk about Central South America, as well as Southeast Asia, which is where I'm primarily based.
And with the US citizens, I know that US citizens are taxed
Mhm,
worldwide, whether they are residents of the US or not.
mhm.
Green card holders, we've had a chat about this before, whether or not it's a good idea to have a green card, to give up a green card. If you've been present in the US, is it 8 out of 15 years you can elect? I'm not quite sure of the situation there, so perhaps you can comment on that.
Absolutely. So you're absolutely correct, of course. As a US taxpayer, you're taxing your worldwide income. So that'll primarily be citizens and those who qualify under Section 7701, which will be permanent residents, or those who trigger substantial presence. Substantial presence being a bit of a convoluted calculation. It's 183 days, but it includes the 2 prior years as well. I won't get into it, but once you are US exposed, you're taxing your worldwide income. If you leave the US, if you're a citizen or green card holder, you continue to be taxed on your worldwide income. So it follows you around. If it is that your taxation was triggered by substantial presence, which may be the case of some visa categories like the E's and the L's, for example, then you can leave that taxation behind and you just be taxed on your US source income.
But if you hold on to your green card, you carry on being taxed.
Correct, correct. So as long as you keep your green card or your citizenship, that taxation will follow you wherever you go.
Is it a good idea to give up your green card?
I perhaps will be in the minority. First of all, I think that the tax tail shouldn't wag the dog. So it depends on what the client's needs are and what their ultimate objectives are. And to me, that drives whether you want to hold on to something like a green card. Personally, I'm hugely in favor of holding on to it. Why? Right now, the U.S. is an extremely attractive jurisdiction. I mean, from a business point of view, financial markets, in terms of the world of opportunity. In addition to which, it is the number one jurisdiction of choice for high net worth individuals. So wherever there are a number of bodies which study the movement or the migratory patterns of high net worth individuals. So those with investable assets of over a million, centimillionaires, investable assets of 100 millions or more, and billionaires. And again, the destination of choice and the cities, the number one cities to attract and retain high net worth individuals is disproportionately in the US. So it is a huge magnet. So if it is that you're planning to spend some time abroad, so you're going to leave, I would just keep it in your back pocket so that the US remains an option. And especially if there's a substantial portion of your wealth. So for example, you have a business set up in the US, or you have some investment properties or whatever the case may be, and you want access, easy, unfettered access to your business to meet with, to have board meetings, to meet with key suppliers or customers or whatever the case may be. Again, I would keep it from an immigrant, like an immigration document, because as we saw during the recent health crisis, yes, travel was particularly difficult, but at no point were US citizen, denied entry or egress. Same with green card holders as well, lawful permanent residents. So if only for that, I would keep it.
Okay, so judging from what you said, and I've had one or two clients who've actually given up
Mhm.
their US citizenship, you would probably advocate against that. But on the basis that you do give up your US citizenship, can you tell me a little bit about the exit tax that would apply? And would the exit tax apply to green card holders as well?
Right, that's a good question. And yeah, I always give my point of view, but to your point, we do 2 or 3 clients every month who are giving up their citizenship for green cards, right? So it is a personal choice. If it is, yes, an exit tax may apply. If it is your citizen and your net worth is in excess of $2 million, or you've had a tax liability on average over a certain threshold, it moves with inflation, but I think it's roughly, let's say, $180,000 for the preceding 5 years. Or if it is that you're a long-term permanent resident, what we mean by long-term, so you've held onto your green card for at least 8 years. So then you trigger. So if you've held on to it for, fewer than 8 years, then exit taxes won't particularly be a concern. So again, for that long-term permanent resident, you trigger what we call covered expat status by virtue of your net assets being excessive, 2 million, your average tax liability be in excess of, let's say, $180,000 over the past few years. There's another way of triggering it, which is those who refuse to disclose what their assets are, but we don't typically deal with that type of client. So essentially, yes, you may trigger that exit tax, and how the exit tax works, just real top line. You create a balance sheet, if you will, of what your assets are, what the basis is, so the cost price, as well as the market value. And we look at the delta between the two, and that delta, is looked at in terms of a deemed disposal. And we know you're not going to sell it, but you kind of pretend as if you are, and based on that, the tax is calculated.
Well, it's unlike some countries which do have an
Mhm.
exit tax, but they also have a step up in basis on when they come into the country. I believe that in the
Mhm.
US you don't have that step up in basis, so it seems a little bit unfair. Somebody could have come to the US with a low cost asset and
Yeah.
uh, and be taxed on exit.
Absolutely. One can have that conversation. Of course, as professionals, we all advocate pre-immigration tax planning, regardless of where you're going to, but the vast majority of people do not. And as you rightly pointed out, there's no automatic step up in basis. So as part of the pre-immigration process, we do certain things to step up basis. But if you didn't take advice, then you're right. You can be in a painful position should you wish to
And
exit.
what would you suggest as a to create that step up in basis? Transfer to a trust or something, or what would you suggest there?
Yeah, there's certain things like a check the box election. If it's a portfolio of publicly traded equities, for example, you can sell and repurchase. So it really depends on the asset class and the nature of your holdings. Then there may be a way, not always, but there may be a way to effect that step up in basis. Yeah.
And on the basis that you transfer to a trust, for example, before you
Mhm.
arrive, so you sell to a trust, can you just briefly explain, I probably won't be able to do it that briefly,
Yeah.
the grantor and the non-grantor areas, so that when actually somebody is a US resident, how are they taxed on the income of the trust?
That's another common question. Once we get on to calls for U.S. pre-immigration tax planning, the first thing that people want to talk about is a trust, and naturally so, because the media plays with it a lot, plays with the concept, and creates the idea that it's this panacea, there's this silver bullet that will solve all their problems. Unfortunately, it does not. So under the U.S. tax code, you have grantor trust and non-grantor trust, which roughly equate with revocable trust under England and Wales and irrevocable trust. So that's roughly what it is. Now, by virtue, regardless of whether it's a grant or non-grantor trust, having a foreign trust, it's a good idea. So we never discourage people because of two things, asset protection and succession planning. As we all know, the US is very litigious, and I always tell people, if you do business in the US and you haven't been sued, it just means you haven't been in business long enough. Everybody gets sued at one point in time. It's just par for the course. And it is super helpful to shield your assets and have it in that foreign trust. There's also succession planning. You legally avoid probate, and more importantly, if you trigger the estate tax, then those assets already in that foreign trust would be shielded from that calculation. So that's helpful. Now, but from a tax point of view, in terms of an income tax, if it is that your trust is categorized as a grantor trust, which most of them would be, then unfortunately a grantor trust or foreign grantor trust for US tax purposes is transparent. So all the distributions within or the income producing activity within the trust flows directly onto your personal tax return. If it is that you have a non-grantor trust, then yes, you will only, at the very least, you'd only be taxed on that portion of the distribution that will go to a US exposed beneficiary. But if it is that if you've settled a trust and therefore you're the grantor of the trust and you move to the US, within 5 years, it's automatically a foreign grantor trust. So even if it's set up to be an irrevocable trust, no, it's going to be a foreign grantor trust,
Okay.
unfortunately. So there's no tax benefit. They also, because of this very nature, people want to engage in tax planning. The IRS has a series of code sections from I think section 671 to 677, excluding 672, I think, that deem trust to be grantor trust for just the slightest amount of control or that a US exposed person would be. So in fact, what you have is a situation, you need to plan outside the 5 years, and chances are you probably would have needed to get US counsel involved to ensure that it was drafted in contemplation that the trust would become US exposed, which many people don't. So that's why most don't qualify. So the foreign grantor trust, in summary, is the holy grail, but it is difficult in the pre-immigration tax planning process to achieve.
Okay, so controlling in any way of that trust
Anyway.
can cause a big problem. Okay, so we've now got people who have been in the US and who are now leaving the US. Let's talk about where they go.
Yeah.
They might be going to the UK. Of course, we've got we're right in the middle of our non-dom changes now, but they might be going elsewhere. Where would you typically find your US clients going to?
Well, the destinations of choice, again, looking at the high net worth migratory patterns right now, outside of the US, you're looking at Europe, right? And again, it's a big change since COVID. People are becoming very conscious of, health, and you're looking for jurisdictions that offer awesome healthcare. And as things become a bit, uncomfortable in certain jurisdictions, you're looking for safety as well. Safety comes as a premium. So in terms of the clients that we normally encounter in our ecosystem, it's Southern Europe, so France, Spain, Portugal, the Emirates, primarily Dubai, but the Emirates is just more than Dubai, so just generally the Emirates, as well as Singapore in Southeast Asia. Those are the common jurisdictions that we get involved in.
So you've eliminated the UK because of the need to have health care and the state of the NHS at the moment.
I haven't eliminated it. It's just that we don't get involved in that. First of all, statistically, there's been a net outflow of so-called high net worth individuals from the UK over the past few years. And this is before any discussion around changes in the non-dom regime, which is, again, reinforcing the narrative that I threw out at the beginning, which it seems to be counterintuitive, but the data is rock solid. Again, I just want to throw out for those who want to take a deeper dive down that rabbit hole. There's Professor Christobal Young from Cornell University, peer-reviewed journals, lots of economists looked at it, rock solid, anonymized IRS data from within the US and from Forbes and other sources for international movement. And again, high net worths are not driven by taxes. So having said that, within our ecosystem, It's just that people knock on our doors when it comes to Portugal, Spain, and France because we put out a lot of content around those jurisdictions and what they have to offer from a tax point of view.
Okay, that's very interesting
Mhm.
that the high net worth individuals aren't motivated by tax. And that to some extent means that all of this changes in the non-dom debt legislation, which are tax driven, is actually no benefit at all to the high net worth. They're going to move because of other reasons, if you like, or they might
People
stay for other reasons as well.
Exactly. People do what they want to do. And from a UK point of view, again, I know that you're based in the UK, so you know way more than me, but there have been recent changes in the past decade or two with the non-dom regime. And again, people are running around, the sky is gonna fall, the sky is gonna fall. And then nothing happened, right? Yeah, so things do, I mean, not to say that there are individuals that won't move. And the media, of course, because they're chasing clicks, they will grab onto those high profile individuals. But anecdotes do not make the case. And statistically, they are not driven by taxes. So you're correct. Nothing is going to happen.
So now, with the Spain, and I know Portugal has changed its
Mhm.
rules as opposed to the non-habitual resident, but you've got Spain and Italy with beneficial tax regimes. If you've
Mhm.
got a US citizen that is going to be
Mhm.
subject to full US taxation on all of his income anywhere in the world, wherever he is resident, are these beneficial tax regimes useful for US citizens going abroad?
Potentially there would be. I mean, bear in mind that they're all going to be temporary in nature, but at least for that initial period, it is something to consider. France doesn't have any. They have an impatriate regime, but for the high net worth individual, they're not really on a salary, so that maybe doesn't make a difference. Italy has one as well, and Belgium and some other jurisdictions. So the Spain, we mentioned Spain, there's the Beckham law. More recently, there's like a startup law, which Portugal has mimicked. So what in fact happens, Portugal is still in play, but they've kind of shadowed what Spain is doing. So Portugal is saying just by virtue of showing up, you're not going to get a 10-year break. What you can do, however, if you start a company that's bringing jobs to Portugal, then yeah, this could be interesting. And if you are an employee under that company, then you effectively have a quasi-territorial tax regime. So therefore, your Portugal source income will be taxed, and there's a lot of, it's like somebody said, it's like the Swiss cheese of regimes. So there are quite a few exceptions, maybe, but for the most part, your foreign source income is not going to be taxed, and you can bring it in. So whether you leave it outside or bring it in is irrelevant. You can do what you like. We're just going to tax your domestic income for 10 years. Spain says the same thing as well. There's a startup regime, so we prefer if you start a company, but even if you're a digital nomad, a so-called remote worker, yeah, come. And for a period of, I think it's 6 years, then right, we will treat you as tax non-resident, even though from an immigration point of view, you are resident. And we'll only tax you on your Spain source income, which you do outside. We're blind to it. You can bring it in if you want, but it's only for 6 years. So Italy has that flat tax of 100,000, which again is quite competitive compared to Switzerland's 300,000. So I think those three countries are attractive and interesting right now. We see most demand being for Spain, as things have been a bit uncertain for a number of reasons in Portugal, but they all are quite popular and generating quite a number of inquiries right now.
Does the EU in particular, and perhaps the
Yeah.
OECD, does it
Mhm.
frown upon these beneficial tax regimes as being sort of unfair competition for local residents compared to local residents?
I think it does. So, I mean, it goes hand in hand with the so-called golden visas. It's an open secret that Brussels, London, and Washington, D.C. do not like these golden visas, especially when it leads to citizenship without any real connection to the jurisdiction. They just don't like it. and they've been wielding some soft power, and now they're becoming a bit more overt with it. As we know, Malta is being taken to the European Court as a result of it. We believe that pressure is being exerted on other jurisdictions as well, because remember, there was a time, this is before COVID, so before 2020, you could have moved to Portugal from another European country like the UK or Sweden, and you would just not be taxed on pension income. As a result, I think it was Sweden got very upset and they unilaterally revoked the Sweden Portugal tax treaty. They complained to Brussels. Brussels put pressure on Lisbon, and Lisbon implemented that 10%. So we know it happens, and it goes hand in hand with the golden visa thing. But Brussels is being quite strategic. They're saying, first off, because once you get access to one European country, you have access to all. So you can't claim autonomy and say you're going to do what you want, because it impacts everyone else. So let's harmonize our position. And I think the case study that the jurisdiction that they seem to prefer as an example would be Austria, which under someone makes an extraordinary contribution, which is subjective, quite subjective, but the bar is relatively high. Austria will say, yes, welcome to Austria. Here's a passport as evidence of your citizenship. So again, for some sort of extraordinary contribution, yes, but to just rock up and write a check for $500,000 or €1 million and you get those benefits, they clearly don't like it, and they go hand in hand.
You mentioned Austria. That's one of the countries that does have that step up in basis of the assets when they come into Austria. So one could come into Austria with your assets waiting to be sold. You then sell the assets once you're in Austria, you make a capital gain, but the basis of the capital gain is the high net value when you actually went into Austria. So actually the gain is negligible. That's a very, very attractive proposition.
It is a very attractive proposition indeed, but more importantly, it doesn't play negatively in the political arena. So you don't have like this two-tier system where you have a certain class of citizens who are not taxed at their worldwide income, and some that are, and some that even when you exclude the worldwide income, even their domestic income may get some sort of special privilege. So it's that two-tier system that it seems to be creating disharmony.
That's an interesting concept. I was reading this weekend about Rishi Sunak's wife and how she earning huge amounts of money on dividend income. It was foreign income. Therefore, as a non-dom, she wasn't taxed, and she morally thought that was wrong and decided that she would voluntarily accept UK taxation on a worldwide income. How much do you think morality is now coming into play with taxation?
It has become a moral argument. So it's not what is legal, but what is seen to be fair. And
When
of course,
you say that the divergence with other people, with people who are resident of that country, and people come in from abroad, like your US people coming into Spain, Italy, it does create a two-tier system, really. So there is that moral ground that is interesting.
It is, and and then taking a step back of what's going on geopolitically, we see that across the world there's an increase in social instability, and it would manifest itself in different things, political instability, crime, but there is an increase in social instability, and the last thing a government wants to do is add fuel to those flames. And if it is that people are going to be super sensitive, especially as we have economic struggles in most jurisdictions right now, you want to create the impression that things are being fair, that everybody's paying their fair share as we go through a collective struggle. So you're absolutely right. It's a real concern, and governments are wise to pay attention to that concern.
Okay, well, I mean, I think on that basis, on the issue of morality, I think we can end this podcast. Thank you very much, Darren, for joining me today. It was really interesting and informative. And I'd like to thank our listeners for joining us today. So again, thank you, Derren.
Thank you. It's been a pleasure and a privilege, Roy.